Limited resources and unlimited liabilities make sole proprietorship and partnership risky. Growing business needs require capital, skills, and limited liability. The joint stock company emerged to meet these demands. This video explores the benefits of a joint stock company. A joint stock company is a type of business organization in which ownership is divided into shares, and the liability of the shareholders is limited to the amount of capital they have invested. The characteristics of a joint stock company are as follows. A company needs at least 2 people to be formed. For a private company, 2 people are needed, while 7 people are needed for a public company. A company is an artificial person created by law that can buy, sell, own property, and sue or be sued, just like a human being. A company is a separate legal entity that is distinct from its owners. This means that the company can enter into contracts, own property, and be held liable for its own actions independent of its owners. As a legal entity, companies use a common seal since they cannot sign documents themselves. This seal has the company's name engraved on it, and when used on papers, it acts as a signature. Shareholders of a company are only liable for the amount of shares they own or guarantee, making their liability limited. Shares of a company can be sold or transferred to another person subject to certain conditions. Private companies may impose restrictions on the transfer of shares. A key feature of a company is the separation of ownership and management. Shareholders, who may be located across different geographic locations, entrust the management of the company to the directors. Private companies need a minimum of 2 members and can have a maximum of 50 members, excluding employees. Public companies require a minimum of 7 members, with no maximum limit. A company's actions are limited by the Indian Companies Act, Memorandum of Association, and Articles of Association. Going beyond these can lead to the winding up of the company. Memorandum of Association specifies the company's constitution and activities, while Articles of Association detail the rules and regulations for the internal management of the company. A company is created and dissolved as per the Companies Act and cannot be terminated by any means other than legal process. An entrepreneur, under the company form of organization, has a further choice to incorporate an enterprise as a private company, public company, one-person company, OPC, limited liability company, or a Section 8 company. In this video, we will limit our discussion to private and public limited companies. Let's take a look at the differences between the two. Private companies can have a maximum of 50 members, while there is no limit for public companies. In private companies, shareholders' right to transfer shares is restricted, while it's not restricted in public companies. Private companies cannot invite the public to subscribe for shares, debentures, or deposits, while public companies can. Private companies have a minimum paid-up capital of 1 lakh rupees, while public companies have a minimum paid-up capital of 5 lakh rupees. Private companies use the word private limited at the end of their name, while public companies use the word limited at the end of their name. Private companies are the most preferred type of business organization for the following reasons. 1. Private company requires only 2 members to form, while a public company needs a minimum of 7 members. And only 2 directors are required to validate meeting proceedings. Private company can file a statement in lieu of prospectus with the registrar. It can commence business immediately after incorporation, whereas the public company needs to obtain a certificate of commencement of business before it can start its operations. Holding of a statutory meeting or filing of a statutory report is not required, whereas it is mandatory for a public company. Non-members cannot inspect copies of profit and loss A/C filed with the registrar. Limit on payment of maximum managerial remuneration does not apply. Restrictions on appointment and reappointment of managing director do not apply. Maintaining an index of members is not required. Directors of private company need not have qualification shares. If you're considering starting a business, the company form of organization may be a good choice for you, especially if your venture is in a heavy and basic industry type. You'll be conducting large-scale operations. You'll need to raise significant funds to start or grow your business. Your enterprise involves significant risks. Your enterprise is technologically complex and sophisticated, relying heavily on experts and professionals. Starting a company in India? Don't forget these essential legal formalities to get your business up and running smoothly. Obtain Director Identification Number, DIN, and Digital Signature Certificate, DSC. Apply for company name approval. File incorporation documents with the Registrar of Companies. Obtain Certificate of Incorporation from ROC. Apply for Permanent Account Number, PAN, and Tax Deduction and Collection Account Number, TAN. Register for Goods and Services Tax, GST, if required. Open a bank account for the company. Register for employee insurance schemes, such as EPF and ESI, if applicable. To summarize, joint stock companies provide a unique opportunity for entrepreneurs to pool resources and share risks while enjoying separate legal entity status. Thanks for watching. Like, share and subscribe for more such videos.